Banks taught you debt is dangerous. Meanwhile, millionaires are using your savings deposits to buy real estate and get rich. The leverage strategy they use is hidden in plain sight. And by the end of this video, you'll understand exactly how they do it. Here's something that will make you question everything you were taught about money. The average millionaire real estate investor carries more debt than you'll earn in your entire lifetime. And they sleep like babies while you stress about your car payment. Why? Because they understand something banks desperately don't want you to learn. There are two types of debt in this world. Consumer debt drains your wealth every single month. But strategic debt? It builds empires. The difference isn't the amount. It's what the debt does while you sleep. A mortgage on a rental property that pays you $2,000 monthly isn't the same as a credit card balance for a vacation. One makes you poorer. The other makes you richer. And the wealthy figured this out generations ago. But here's where it gets interesting. The very banks that charge you 18% on your credit card? They're lending real estate investors money at 6%. Same bank. Same building. Completely different rules. Let me break down the actual math that changed my entire perspective on money. Say you have $100,000 saved. If you buy a rental property outright with cash, and it appreciates 10%, you made $10,000. Simple. Now watch what leverage does. Take that same $100,000 as a down payment on a $500,000 property. Same 10% appreciation. But 10% of $500,000 is $50,000. You just made 5 times more money using the same capital. If this is clicking for you, hit that like button because we're just getting started. This is called the leverage multiplier effect. And it's exactly why wealthy investors laugh when people brag about being debt-free on their investments. Pause twos, but wait. There's a catch that nobody talks about. Leverage works both ways. If that property drops 10%, you don't lose $10,000. You lose $50,000. The same multiplier that creates millionaires has destroyed people who didn't understand this critical balance. So why do the wealthy still take this risk? Now imagine you're a bank executive for a moment. You have billions in deposits from regular people earning 0.5% interest. What do you do with that money? You lend it out at 6, 7, 8% to real estate investors. The spread between what you pay depositors and what you charge borrowers. That's pure profit. Music shift, here's the part that should make you uncomfortable. Every dollar sitting in your savings account is being used by someone else to build wealth. Your money. Their empire. You get 0.5%. They get 20% returns on leveraged properties. The system was designed this way. Banks need savers to fund borrowers. They need you afraid of debt so you keep depositing. They need investors comfortable with debt so they keep borrowing. It's a perfect machine. And you're the fuel. But here's what they never tell you. Pause twos, you can be on either side of this equation. Nothing stops you from becoming the borrower instead of the depositor. The knowledge isn't hidden. It's just not advertised. Because banks make more money when you don't know. This brings us to a concept called velocity of money. And this is where things get really interesting. Traditional thinking says save money, accumulate it, watch it grow. Wealthy thinking says make money move. Here's a real example. An investor buys a property using bank financing. They renovate it, increasing its value. They refinance, pulling out their original capital tax-free. Then they use that same capital to buy another property. One pile of money. 2 income-producing assets. The original investment is recycling through the system, multiplying its effect. This is called the BRRRR strategy. Buy, rehab, rent, refinance. Repeat. And it's how investors turn $100,000 into a portfolio worth millions without ever adding new capital. The money never sits still. It's always working. Always moving. Always multiplying. But that was just the beginning. Because what happens when you combine velocity with leverage? What happens when you're moving borrowed money through this system? That's when the numbers start looking almost impossible. And that's exactly what banks don't want becoming common knowledge. But here's where everything I just told you, that's just the setup. Because there's a psychological component to this that separates the wealthy from everyone else. And I need you to pay attention to this next part. Pause twos. Most people have been programmed to feel physical discomfort when they think about owing money. Their heart rate increases. Their palms sweat. Debt equals danger in their nervous system. This response was trained into you through education, media, and watching family members struggle. And it's costing you a fortune. Wealthy families teach their children the opposite. They teach them to see debt as a tool, a lever, a multiplier. The emotion isn't fear. It's excitement about opportunity. Same situation. Completely different response. And here's the truth nobody tells you. If you stay subscribed, you'll understand why this matters for your future. Your emotional programming around money was never designed to make you wealthy. It was designed to make you a reliable depositor, a predictable consumer, a fuel source for the financial system. Reprogramming this response is the first step toward thinking like an investor instead of a consumer. Now let's talk about something that makes traditional financial advisors nervous. It's called the debt-to-equity sweet spot. And getting this wrong destroys investors. Getting it right creates generational wealth. Professional real estate investors typically operate between 60 and 80% leverage. That means for every $1 million in property, they might have $600,000 to $800,000 in debt. Sounds terrifying to a saver. Sounds strategic to an investor. Here's why that range exists. Below 60% leverage, your returns start looking mediocre. You're not using the multiplier effectively. Above 80% leverage, your risk increases exponentially. One market dip wipes you out. The sweet spot maximizes returns while maintaining a buffer for market fluctuations. But here's what shocked me when I first learned this. And what do you think determines where in that range an investor should operate? Drop your guess in the comments. The answer isn't random. It's calculated based on cash flow coverage ratios. If your rental income covers your debt payments by 1.5 times or more, you have breathing room. If you're at 1.1 times, you're one vacancy away from disaster. The wealthy understand this math intimately. They never just wing it. Let's bring this full circle and expose what banks are really doing. Pause twos. When you deposit money, the bank doesn't just sit on it. They're legally allowed to lend out roughly 10 times your deposit through something called fractional reserve banking. Your $10,000 deposit enables $100,000 in loans. Those loans go to investors buying real estate. Those investors pay interest to the bank. The bank pays you almost nothing. This is the multiplier working against you instead of for you. Now flip the script. When you become the borrower, you're harnessing that same fractional system. You're on the profitable side of the equation. The bank creates money essentially from thin air to fund your property purchase. You pay interest, yes. But your tenant pays that interest through rent. Meanwhile, your property appreciates. Your loan balance stays fixed while inflation makes it cheaper in real terms. The same system that enriches banks can enrich you. You just have to understand which side of the desk to sit on. This is the leverage strategy they don't teach in school. Because schools are funded to create employees and depositors, not investors and borrowers. So here's the reality check before you rush out and leverage everything you own. This strategy works when executed with discipline and education. It destroys people who skip steps. The investors who succeed spend months analyzing markets before buying. They stress test their numbers for worst-case scenarios. They maintain cash reserves for vacancies and repairs. They never leverage beyond their ability to cover payments if everything goes wrong temporarily. The ones who fail? They see the returns and ignore the risks. They buy emotionally instead of mathematically. They leverage to the maximum because they're greedy. Then one recession reveals their fragility. This isn't a get-rich-quick scheme. It's a get-rich-inevitably strategy that requires patience, education, and emotional control. The wealthy don't just understand leverage. They respect it. They fear it appropriately while using it strategically. That balance is what separates empire builders from cautionary tales. Start with education. Study markets. Analyze deals on paper before committing money. Build your knowledge base before building your portfolio. Now let me address the elephant in the room. Interest rates. Everyone says high rates killed real estate investing. But here's what experienced investors know. Every market condition creates opportunity. When rates rise, competition decreases. Fewer buyers means better negotiating power. Sellers become desperate. Deals that were impossible during low-rate bidding wars suddenly become possible. Yes, your debt costs more. But purchase prices drop. Cash flow calculations change, but they don't disappear. The investors buying today at 7% rates? They're positioning for the refinance when rates eventually drop. Lock in a lower purchase price now. Refinance to a lower rate later. Double win. Meanwhile, everyone else is waiting on the sidelines for perfect conditions. Perfect conditions never come. There's always a reason to wait. The wealthy understand that imperfect action beats perfect hesitation. They adjust their strategy to current conditions instead of waiting for conditions to match their preferred strategy. This flexibility is a superpower that most people never develop. Let's talk about what happens to your existing wealth when you don't use leverage. This is called opportunity cost, and it's invisible, so most people ignore it. That $200,000 sitting in your account earning 2%? It's not just earning 2%,